We recently released a video where I invested £10 a day for an entire year, and I think it's fair to say that a lot happened during that year. We saw crazy highs and lows, and after publishing, we received a number of comments telling us what we did wrong and what we should have done instead. So in this video, we're going to be going over what we learned from the experiment and addressing some of the thoughts that we received after posting it. Obviously, nothing we say in this video is financial advice, and your capital is always at risk when investing. If there's one thing that this experiment really highlighted, it's that investing should always be for the long term. 1 year is simply not enough time to see any real growth, but it is enough time to potentially lose a lot of money. And this video was a great example of that, even though the year we were investing was a bit of an anomaly. Within the year, we saw steady growth to begin with, only for it to all be taken away and more by a pretty huge stock market crash in early 2025. Thankfully, by the end of the experiment, we'd managed to recover from the dip and come back out in profit. But what it showed us is that time in the market is really important. Let me explain. If we'd decided to cash our investment out after the market dropped, then reinvest it a few weeks later when it started to climb back up, we'd have made a loss. Instead, sticking to our plan and riding out the tough times proved to be really important, at least in the year that we were investing. We were fortunate in some ways with this being such an extreme example of market volatility within a year, as it allowed us to demonstrate what decades of investing tends to look like. Periods of steady growth, plateaus, market crashes, and great recoveries. Because these things typically tend to happen over years rather than months or weeks, it's so important to zoom out from the present and think about the long-term side of things. Now, I don't speak for everyone, but usually when people invest their money, they have a goal in mind. Whether that's making sure they have a comfortable life in retirement, or that they can afford to give their kids a house deposit. Things like that. For me, I just wanted a good video at the end of the year. When the market crashes, just like it did in our experiment, it quickly becomes very easy to see those goals drifting away. The long-term future goals quickly get replaced by the fear of short-term losses. Panic might set in, and you instinctively hit the sell button, but this is where your mentality is so important. If you're truly in it for the long haul, then you shouldn't be paying too much attention to these dips in the market. It's well documented throughout history that the global market will fluctuate a lot, and so far, it's always recovered. Touch wood. We can't use past performance to predict the future, but lots of empirical evidence supports the idea that the markets should grow long term, and it's not just a belief based on previous trends. What doesn't help with the mental side of things is all of the chatter going on around you. Media outlets, social media, your mates at the pub, whoever it is has just as good of an idea of what will happen to the markets as my pet goldfish. Although he did warn me about the dot-com bubble. Wherever you look, it seems to be negative, whether the market is good or bad. If it's currently up, it's about to come crashing down. If it's on the decline, then buckle up as it's gonna get worse. At the end of the day, there aren't many people, if anyone, that knows what will happen with the market in the next 5 years. So all you can do is make what you deem to be good financial decisions throughout your life and see what you're left with at the end. Ignore the headlines, ignore the online market gurus, just focus on your own financial health and whatever happens will happen. Or don't. I am also someone online, so feel free to ignore everything I say. Multiple commenters told us that we should have invested as a lump sum and left it in the market for the whole year. And yes, lump sum investing has outperformed cost averaging over the course of history most of the time. But cost averaging also has less volatility, which can be more important when investing for a shorter period of time. Some people just feel safer with cost averaging. And hindsight is 2020. That's the beauty of the stock market. We never know where it's going to go, even though we can see it's typically gone up over time. Interestingly, we'd have made more money if we put all of our investment in at the start of the 12 months, but we'd also have made significantly more money if we put nothing in for the first 6 months, then put it all in halfway through after the crash. But yes, lump sum would have worked out better for us in this experiment. Another important thing that was highlighted was the need to include fees, but we actually did include fees within our results. We didn't incur any account fees or trading commissions because I used an investment platform that doesn't charge them. I invested with Trading 212, meaning the only fee we paid was the fund management fees, which you incur on every platform and they're the same regardless of the platform you use, and they were included in the value of our investment throughout. With Trading 212, as well as having no account fees or trading commissions, you can also receive free fractional shares worth up to £100 if you use our affiliate link in the description to sign up. Or you can use the promo code FIN within 10 days of creating an account. And you only have to deposit £1. Another thing we saw a lot was people telling us that we weren't investing the right way. Meaning we shouldn't have just invested for 1 year, we should have been putting money into a diversified pool of investments for much longer than that. And while we do agree with that sentiment, that wasn't really the point of the video. Plus, this wasn't my only investment activity throughout the year. I kept our experiment very separate from my regular investments using Trading212's pies feature. And this essentially allows you to have multiple portfolios within your portfolio. I had one pie for my regular long-term investments, and a separate pie we used specifically for the video, and this just had one global ETF in it, nothing else. We continued our regular investments in our other pie, whilst also putting £10 into this one every day on the side. And seeing as these two are completely different portfolios, one had absolutely no effect on the other than using up some of my annual ISA limit. Another thing we learned is that gold would have been a better place to put our money because the price of it soared, along with a number of other precious metals. But again, hindsight is a wonderful thing, and that actually circles back to one of our original points. You should make what you deem to be healthy financial decisions and just get on with it, accepting the ups and downs along the way. I personally don't believe that precious metals will outperform the stock market long term, and I'm not smart enough to know what will happen in the short term. So I just invest based on my own beliefs. You have to be responsible for your own financial decisions. And if you linger on the what ifs or the missed opportunities, you're more likely to try and gamble your money more aggressively in future. So it's always best to just ignore the small examples of winners and look at all of the many options that would have lost out. Now, I know I said I wasn't going to give any advice in this video, but there is one thing that I can confidently tell you not to do, and it's the final thing that I learned from this experiment. Don't invest £10 every day for an entire year. It was just really tedious.